Right then, good afternoon everyone, and welcome to another end of week review of financial markets, where we've had a bit of a choppy week, bit of upside, bit of downside, but obviously we will try and make sense of it as we go on through this video. But Monday, as you can see, not a great deal out over the course of Monday into Tuesday. We did have the RBA, Reserve Bank of Australia, hiking rates again by 25 basis points, signaled the need to continue hiking interest rates due to the levels of inflation still being high. So expect more rate hikes out of Australia, and maybe keep an eye on the Australian dollar for some further upside across a number of different currencies. I mean, you see a couple of different central banks stopping hiking interest rates. For example, the Canadian central bank, the Bank of England, are approaching the end of it. The Fed are approaching the end of it. How long the end of it becomes is obviously a little bit tricky. So I'll probably keep an eye on Aussie CAD and Sterling CAD for some potential upside in the Australian dollar in the months to come. Obviously, you can't. It's not going to be a straight line up. You need to try and buy dips, but I think the longer they continue hiking interest rates and the longer inflation continues to be a problem, which it did rise in Q4 of last year, continues to rise in that country, it's definitely something worth keeping an eye on in the coming weeks and months. Across into Thursday, with some inflation figures out of Germany on Thursday, slightly higher than the previous figure, but lower than consensus, so a little bit difficult to read into that one in isolation. Inflation is still too high. The ECB still needs to keep the foot on the gas in order to tame inflation. We're obviously expecting a 50 basis point hike at the next meeting, which we did allude to last week, and there is probably going to be some more to come after that. We just do not have a definitive answer when it comes to that, unfortunately. This morning, as you can see, some GDP figures out of the UK showing I was going to say, I don't know, showing neutral growth. Is that was probably the right word, isn't it? Neutral growth. No growth at all. 0% in terms of the quarter over quarter figure, 0.4% in terms of the year. So that is one quarter of the central bank's predicted recession at the back end of last year avoided, right? So that is slightly positive for UK related assets, but they still are the they're still the economy, in the economy out of the G8 most likely to enter a recession, and the recession most likely to be the worst as well as it comes. As you look across the G8, market participants are a bit more bearish on the UK economy as they are than the others. And then into inflation. We've got some inflation prints next week. We had inflation out of China this morning. 2%, 2.1% was the actual consensus, 2.2, so slightly lower than anticipated, but again higher than the previous. So, inflation in China is not that strong, a 2% inflation over the course of the year. It's pretty standard, so there is not much to see there. Pretty quiet economic calendar over the course of this week. The main focus of attention was Jerome Powell on Tuesday, with a speech from Jerome Powell. First time really speaking after the interest rate decision of last week, and he probably did strike a bit of a hawkish tone. If you think about what he was saying, he said, that obviously they need to keep hiking interest rates, but if the labor market continues to be as hot as it is and inflation continues to rise, they will have to hike interest rates more than what markets currently have priced in, right? Flick back to the charts and we'll have a look. You can see euro dollar futures for March are meeting next month, priced in at 94 here, which they would then allude to a 5.1%, 5.1%, which is what the central bank were targeting for a terminal rate that would bring us up to 5% on the actual interest rate. And that is then difficult to read into because they will have to keep hiking. Well, maybe not that difficult to read into. They will have to keep hiking interest rates after that. They said they're going to keep hiking interest rates. So when you think about that and what that means for assets, you can see the 10-year yield just above top left of the screen, kind of breaking through the highs today and then continuing slightly higher. So yields rising. You can see a bit of the stock index, a bit of weakness in the S&P 500, and you've also got a bit of strength in the US dollar. The US dollar pulls back from the highs. That's euro dollar. Coming to the dollar index, basically the same thing. Has had a bit of a pop higher, right? So that is a few different things in lining. That aligns with the potential increasing hawkishness from the central bank. You would expect to see yields rise off the back of higher interest rates. You'd expect to see the stock market fall, and you'd expect to see the currency rise in line with the yield. right? So that is the expected reaction to something like this. And if that bond yield, if that 10-year yield keeps continuing to push higher, it should keep the S&P 500 pressured and should prove supportive for the US dollar going forward. Now, going forward is then the question as we look into next week. We've had the chair of the Fed on Tuesday suggesting that, if inflation continues to come in higher, they're going to need to keep the foot on the gas. If the labor market remains strong, they're going to need to keep the foot on the gas. And you come over to inflation as of next week. As you can see, CPI out of the US at 130 on Tuesday. Now, market consensus is for this to be lower, right? It is for this to drop, is for this to be lower. But there are a number of market participants suggesting that this inflation print may actually be higher. You've got rising commodity prices, namely oil. Oil pushing higher does put pressure on inflation. There's a couple of other reasons as to why people may think that. You can read different reports from different people. People have their own kind of suggestions. But I think the main thing of oil continues to rise, which it has done today, as well as obviously recently. That continues to be a bit of a bit of a problem. If we just get up the oil chart, get this then across here, get rid of that. You can see then oil has risen over the course of this week. We did have this pullback from the highs then over the last week, but then has continued to push higher over the course of this week. And kind of where we started year to date, we were up kind of double-digit percents, but where we started kind of year to date, we were up double-digit. This move higher from here, sorry, was up double digits, and we're starting to get back towards a double-digit move higher if we can get back towards this resistance level. Now, oil has continued to pop higher over the course of today. Did get through the highs and did pop higher today off the back of reports that there was some escalation, in Russia, right? Moldova and Romania have suggested that there was Russian missiles that flew over both of those countries in order to get to Ukraine. Now that is a bit of a, that's not something that the markets will want to see, right? That's not something the markets will want to see. That is then a negative that could show some increasing kind of escalation in the tensions there. And they also did, in the kind of more relevant to oil in particular, they did decide to cut production, right? They decided to cut production and said they will not sell to anybody that is not in line. They will not sell to anybody that wants to buy at the reduced costs that world's put in the price cap on Russian oil. That the world has said is a thing. Russia have said that anybody that refuses to pay our prices, we will not sell to them. So when you take all that into consideration, and you think what that means, you would expect OPEC to then come over the top and then well, I say you'd expect. I mean, you probably wouldn't expect knowing them, but OPEC in theory then should come over the top and then increase production to offset that difference. But Russia have cut production of oil. OPEC have said that they are not going to increase production of oil. So what that does is that tightens the supply of the commodity, right? That tightens the supply of oil, right? And if that continues to get oil to push higher, you do tag up towards these highs, and when you do get above those highs and start kind of trending higher again, get back above 80, above 85, that then becomes increasingly difficult to manage inflation. You got rising oil prices causes increased levels of inflation, which means interest rates need to go higher. So couple all that together, and you might think to yourself over February and March, you might get a rise in the rate of inflation, and then that is going to be negative for risk. Negative for risk is going to push interest rates higher. It's going to push yields higher. It's then going to push the dollar higher. All that stuff contributes to stock indexes lower. So I think we've got an interesting week next week, interesting day, certainly on Tuesday, with that inflation print. And if that inflation print comes in high, surely that's an easy sell of the S&P 500 and an easy buy of the dollar. But obviously we'll have to see how that plays out as it comes into next Tuesday. But definitely worth keeping an eye on. It will definitely be an interesting print into Tuesday. Is it worth getting short now? The S&P, boy, is it worth getting short risk now over the weekend into Tuesday? I don't know. Might be worth a punt. Or obviously trade it in the release. But I think positioning yourself ahead of this type of an event, not the worst idea. If you've got a bias, which I think I do have a bias, I think short stocks off the back of a higher inflation print, off the back of a number of things, but mainly oil itself. think that's worth a little 1% risk in it. But obviously that can be wrong, and we'll have to see next week. But that bond yield, that 10-year yield, keep an eye on that. If that is rising off the back of predictions for higher interest rates, that is then negative for stocks, positive for the dollar. So something definitely worth keeping an eye on as we go into next week. But we'll speak about that in a little bit more detail this time next week, once we've had a bit of time to digest it. But apart from that, have a good weekend. Do get some rest and relaxation in. Recharge the batteries. Back for another week of trading next week. Certainly should be an interesting Tuesday, to say the least. But that's it from me then, folks. Have a nice afternoon, have a nice evening, and I will speak to you soon.